So hi guys, it's SJ speaking, and in today's video we're going to see about one of the market value ratios to see whether the stock is undervalued or overvalued or fairly valued. If you're trying to investing, you have to look into this ratio. So this is known as price to sales ratio. So before going into the video, I'm personally teaching trading. So if you want to join my trading course and you want to learn trading from me personally, you can contact me which by the number which I've given in the scrolling below on my video. So now let's go into the video. So price to sales ratio, we have seen other many ratios. I have posted videos about price to earnings ratio, that is P ratio, price to earnings growth ratio, price to book value ratio, and price to sales ratio is one among those. So this is one of the market value ratios. So this ratio, what it shows is that how much the investors are paying for 1 rupee of company sales. If company makes 1 rupee of sales, how much we are paying to get that company, to buy that company. So this is what the PS ratio or P by S ratio, price to sales ratio shows. The other names of price to sales ratio are known as sales multiple or revenue multiple. It is also known as sales or revenue multiple. So when the price and sales ratio is seen for mostly people use for analyzing the stock, they use PE ratio or they use some other PEG ratio and they compare ROE and ROC and other things. But when they look at price to sales ratio is that when the company is making losses, it will have negative earnings. There are no profits. So that time PE ratio can't be used. It will be non-applicable. It will not be in the financial statements. So in that case, you have to use the price to sales ratio by comparing the share price with its net revenue. That is the sales that company makes. So how the price to sales ratio is calculated is that the formula is, there are two formulas: market capitalization divided by revenue, or market value per share divided by sales per share. So what is market value per share? It's simply the share price, the current share price which is trading in the market. So the share, the market price which where the share is currently trading in the market is known as market value per share. So what is sales per share? So this is the formula for sales per share: revenue divided by number of shares outstanding. So what is number of shares outstanding is that the number of shares which are issued and which are currently in the market, which are currently outstanding. So that is what number of shares outstanding. So if you substitute the sales per share in this formula, in the second formula, you can get market value per share divided by revenue divided by number of shares outstanding. It is simply a mathematical formula. Is that 1 divided by 1 divided by 2. So you should have, you can rewrite it as 1 divided by 2. This 2 comes upward. So the same scenario happens here. So this number of shares outstanding would go up. So the formula would change as market value per share into number of shares outstanding divided by revenue. So what is market value per share into number of shares outstanding? It is market capitalization. So you can write it as market capitalization divided by revenue. So this is the easier formula to calculate the PS ratio, but you don't need to use the formula. These are already calculated and are posted in various websites such as screener.in and Investello, Trendline, and several other websites. You can see that and refer to. So what we can interpret using this price to sales ratio is that if the price to sales ratio is less than 1, then the company stock is said to be undervalued. If the PS ratio is between 1 and 2, then the company stock is said to be fairly valued. If it is more than 2, then the company stock is said to be overvalued. But you should not use this alone to make your investing decision. You have to compare with the other ratios: return on equity, return on capital employed, RO, price to book value ratio, price to earnings ratio, price to earnings growth ratio, and see whether you can buy the stock or not. So what is this is the example for this calculation. So suppose three companies are there, each having a market capitalization of rupees 367, 356, and 664 crores, and their net revenues are around 580 crores, 129 crores, and 460 crores. So you can see the market capitalization divided by revenue. So you can see the formula, and you can see the first company A is 0.63, less than 1. So it is known as undervalued. So this is more than 2, 2.75. So this is since it is more than 2, it is overvalued. The third company, that is the company C, 664 divided by 460, it is 1.44. So it is fairly valued. So you can, if you are looking into the other factors and find the stock attractive, you can buy the company A. But company B, you have to wait for a correction or something to happen for the stock price to fall below, and you can make your investing decision. For C, you can buy. Of course, you can buy, but still it is not undervalued. You can buy. It is a fair price. You can give the money and buy, invest in that stock. So what is trailing PS ratio? There are every you can easily understand what is trailing means. The how the calculation is done. The trailing price to sales ratio looks at the company's share price related to its past year 12 month sales. So the last 12 months sales are used for the calculation. This is also known as TTM. The TTM is referred to as trailing 12 months. So formula is that market capitalization divided by revenue for past 12 months. So similarly, the forward ratio. The forward PE ratio looks at the company share price related to its estimated future next 12 months sales. So this is the formula: market value per share divided by estimated future revenue for next 12 months. So this is just an estimate which is done by the investors or financial analysts, and the next 12 months sales are usually estimated. So this is subjective to the nature of the analyst. He may be accurate or inaccurate. So the you can't say that if the estimate is 100% accurate, you can't say that it is only an estimate. So next finally comes the limitations. So PS ratio, if even if the PS ratio is less than 1, you might consider as undervalued. But sometimes the bank might, so the company might run on debt. It might even be close to getting bankrupt. So the company might run on debt. So PS ratio does not consider the outstanding debt, how much leverage the company, how much borrowed money the company has. It doesn't take into account. So this is one of the disadvantages. And when you are calculating the forward PE ratio, the estimates are just an estimate, they are not accurate. So this is one of another limitation. And the third thing is that PS ratio only considers the sales and not the earnings. It doesn't consider the profits. So this is used only when the PE ratio is negative. Only people considering the PS ratio for analyzing, but still it doesn't consider the earnings. So if the company A, there are two companies, and company A makes 1 crore profit, company B also, sorry, company A makes 1 crore net revenue, and company B also takes sales of 1 crore, but the profit of company A is 25,000 and the profit of company B might be 15,000. So since company B has more expenses, so margin ratios are less for the company B. So they are not effectively turning their sales into profits. The expenses or their operating expenses are more, so their profit is less. But you can't find those things using the PS ratio. The PS ratio might be the same for both, but only when you are considering the earnings you can find whether the company A is more worth value in investing. So you can see this is what the limitation is. So every ratio has its pros and cons. When you are looking at the PS ratio, you should not see the individual PS ratio. You should see the historical values and see if there is any changes in the PS ratio, whether it's decreasing in value, or you can see whether it's stagnating in the value, or you can see whether it's increasing. And you can also compare with the other competitors which are in the same industry. Suppose if you are buying some pharma sector stocks, you can see the other pharma sector stocks and you can compare and make your investing decisions. So where you can see these ratios, I'll show you. So I've already shown you this screener.in some of my ratio videos. You can see. Um, so wait a minute. Before going into that, let me see. Let me say one thing. So yes, price to sales ratio. I forget to say this point actually. So easier way to understand what is price to sales ratio is that for the company to make 1 rupee of sales, how much you are paying more. This is known as price to sales ratio. I actually skipped this point. I didn't see that. So this is the main thing. This is how you can easily understand what is price to sales ratio. For 1 rupee of company sales, how much you are paying more. So this is what price to company sales. So now let's go into this. So here is the PE ratio. This is the stock PE ratio. On the basis of earnings, how much you are paying more? You are paying around 28 times more than what the company is earning. So you might see it as sometimes how much I'm paying more than 28 times, so it is undervalued. You must compare with the other competitors and see whether they are having the same values or they are having less PE ratio. If they are having less PE ratio, then it is definitely overvalued. If they are all having same PE ratios, then this is not overvalued. So next is return on equity. How much money the company, how much percentage, for example, by using the 100 rupees of shareholders money, it's earning around 24.6 rupees with the shareholders money as well as the long term bonds. how much the company is earning, long-term debt capital, how much the company it's earning around 23.4 rupees with 100 rupees of the long-term debt and shareholders money. So industry PE ratio is this. So earnings growth ratio. So according to the estimated future earnings growth, how much the company is earning. See how much you are paying to get that company. So whether it's undervalued or overvalued, since it is less than one, it is undervalued. When in terms of earnings growth, so in EPS, how much with one share the company earns around 14.7 rupees. And this ratio I didn't explain. I will explain in the next video. And you can see price to book value based upon the real value of the share, how much you are paying. With one worth of 1 rupee worth of the company share, how much you are paying? 6 rupees. Six times more you are paying. And next, intrinsic value, I didn't explain about this. Then comes this video's price to sales ratio. For the company to make 1 rupee of sales, you are making around you are giving around 4 times more. So this is what it denotes. Based upon the sales, you are paying 4 times more. And this is the profit growth for 5 years. So sometimes it is known as compound annual growth rate. So this is ROE for 5 years. So historical growth rate, you can see. Usually these values are taken for trailing 12 months, and this value is for 5 years. You can also use it for 3 years. So this is these are the ratios where I customize myself. You can edit these ratios here. You can put whatever ratio you need, and these are the competitors. Peer comparison. You can compare with the other competitors, and you can see the market capitalization, the current market price, dividend yield, earnings per share, interest, industry PE ratio. So this stock is having PE ratio more than the industry PE. In terms of industry PE, this is overvalued. But you can also compare the other companies and see whether it's okay or not to buy this investment stock. So these are the sales in an intrinsic value. I will explain about these ratios which I haven't explained in my videos before. I will bring new videos for them, and you can see the quarterly results, profit and loss statement, and several other things. So this screener.in would be useful for you to check these ratios. Apart from this, there are several websites such as investorlo.com, Trendline, and Markets Mojo, and several others. I will even bring a separate video for these websites. It will be useful for them. So this is this video, guys. So hope you guys enjoyed this video. So if you like this video, give a thumbs up, share it with your friends and family, subscribe to my channel, and also press the bell icon so you get notified for my videos. So and also comment on my videos if you really like the video. And I'm personally teaching trading, so if you want to learn trading from me, you can call me by in the number which I have given in the scrolling below. By calling my number which I have given in the scrolling below. So I'll give you the details. And I'm also providing 25 members for the first fund 25 members. I'm providing discount on my course, so it will be worth the money you pay, and you can make consistent profits if you join my course. Definitely I'll make sure in that case. And also if you want to open a demat account, you can visit the Zerodha link which I have given in the video description below, and you can start trading and investing by opening the demat account from today onwards. So thank you guys. I will visit you on my next video. Until then, bye bye.